I'm Out Research Market Insights video. Hey everybody, Willie Delwich here. Glad you have tuned in. Topic for conversation today is not the debt ceiling, even though that's in the headlines. Lots of discussion there about how that's impacting bond yields, how that is feeding into concerns that are feeding into the stock market. I think that's mostly noise. I don't think that's really the key driver that we want to pay attention to. I think rather than think about what the Treasury is or isn't doing, I think the market's paying more attention to what the Fed could or couldn't do as we move into the second half of this year. So 3 for Thursday from an insights perspective, the focus here is on the bond market. The market's re-rating expectations for where the Fed is going to take rates over the second half of the year. As we are right now, we've got something for everybody: a pause, a hike, and then ultimately a pivot. We'll take a closer look at how those expectations have changed over the past couple months, and then and where we stand now. The impact the continued higher trend in bond yields means from a corporate bond yield perspective, and what the impact that could have on stocks. And within the bond market, what we're seeing in terms of relative trends, high yield credit versus longer term treasuries, where we want exposure right now within the bond market. So let's get into the charts. We'll start here by looking at this re-rating of expectations that's taken place. We'll anchor this starting pre-banking blow up. So early March, finally the market was starting to believe the Fed was serious about rates higher and rates longer. So year-end projections for Fed funds rate, the market was pricing in a 5.4% year-end Fed funds rate. It was actually above what the Fed had listed as a target of its expectations for year-end. So the market was believing the Fed. 10 days later, you go through a banking blow up. Banks on both coasts having a little bit of trouble. The market shifted. The market pivoted. The Fed never did, but the market did. It went from expecting a 5.5% or close to it year-end Fed funds rate to something shy of 3.75%. So 5.4% to 3.7% in the space of 10 days. Since then, we've seen the Fed has raised rates a couple times, and it has kind of consistently said we don't see rate cuts. We may have to raise rates further. Improvement in terms of fighting inflation has been slower than expected. Economic data has shown some degree of resiliency. And so the market's starting to believe the Fed again. And so all this talk about the Fed pivoting, it's really the market that it has pivoted multiple times now. Either way, Fed expectations for where the Fed's going to be at the end of this year are as high as they have been since just before the banking blow up back in March. It's accelerated over the past 2 weeks. This 4.83%, expected Fed funds rate target at the end of the year. That's up about 50 basis points just in the past 2 weeks. So we're seeing this shift. I think that is what's impacting what we're seeing in terms of bond yields moving higher across the curve, and then stocks struggling outside of a few mega cap names, seeing that broad weakness in the equity market. I think it's this struggle that we're seeing. That struggle is explained by shifting expectations in terms of where we're going to finish the year from a Fed funds rate perspective. Now, beneath this, all this pivoting from the bond market, the long-term trend for yields has kept rising throughout this. The long-term trend for 10-year treasuries, it's up 120 some weeks in a row. That's the most sustained rise in more than 50 years. Here we're looking at corporate bond yields, and you can see it stopped rising at the end of last year, but they didn't fall apart. They kind of consolidated within this a broad but relatively logical level above the peak from 2018 and 2019, below where we were in a decade or so ago. So we had this consolidation as we pulled back from the highs. 26-week momentum actually went negative. That became a tailwind for stocks as they rallied off of the March lows. The bad news from an equity perspective is that tailwind has dissipated. Now, as yields move higher, bond yield momentum has returned to the upside. Long-term trends continue to rise. That all is usually, historically, a headache for stocks. All of the net gains for equities over the past 20 years, over the past 60 years, have come when bond yield momentum has been negative, not rising. So it was a brief tailwind off of the March lows, but because those long-term trends didn't roll over, now the trends have a chance to reassert themselves. That seems to be what's happening as the market starts to listen to the Fed and say, yeah, we need to keep yields higher, need to keep them there longer. We're starting to see a reassertion of those long-term trends. What does that mean within the bond market? Here we're looking at the ratio between long-term treasuries, so think TLT from an ETF perspective, and high yield credit, think HYG from an ETF perspective. Now we're looking at these aren't the ETFs, these are total return indexes, but over the past couple years, the trend has definitely favored high yield credit over long-term treasuries. As yields have been rising, long-term treasuries are more sensitive to higher yields than are ironically enough, high yield credit. So they're more economically sensitive. And so as we're not seeing evidence of economic stress, as the market is saying, yeah, we can price in higher rates, high yield credit has continued to do relatively well. It's not just in a relative uptrend versus treasuries. It's actually in an uptrend now, almost 2 months now on an absolute basis. So within fixed income exposure, which is pretty minimal at this point, steering clear of long-term treasury exposure and increasing high yield credit exposure seems to be the way to go. So that's the insights for today. The focus, while the headlines are on debt ceiling negotiations, I think the news is the market repricing or pricing in a more aggressive tightening posture from the Fed that's putting upward pressure on bond yields as we go into the second half of this year within credit or within fixed income, focusing on high yield credit and the short end of the treasury curve at the expense of long-term treasuries. We haven't seen a turn higher there yet. When we do, we can lean into that. But for right now, it's tilting away from TLT, tilting towards HYG. That's the Market Insights video. That's 3 for Thursday. Thanks for tuning in. Thanks for listening. We'll do this again next week. Hope you join us and tune in.